Alright, welcome back. So we continue. We were looking at from the previous clip. We continue from the previous clip. Alright, we were looking at times interest earned. Okay, so the formula for times interest earned is earnings before interest and tax divided by the interest. So these two numbers are taken from the income statement. So the earnings before interest and tax, you take this number divided by the interest. Of course, you ignore the negative sign here, and therefore you get this value here. You get this value here, 162.57. So this is multiple. So it means that the company's earnings before interest and tax is 162 times, roughly 163 times the interest expense. So higher this number means greater the ability of the firm to service its interest, or pay the interest using the available income. Alright, so that's the measure of times interest earned. This is also known as the TIE ratio, TIE ratio. Okay, the next ratio, is cash coverage, which is an extension or a modification of the times interest earned ratio. Note that the times interest earned ratio is an accounting measure of income, earnings before interest and tax. It's not a cash flow measure. Therefore, here we use a cash flow measure of income. So here it measures the operating cash flow as a multiple of interest expense. Reflects the operating cash flow available to cover $1 of interest expense. So for this, what we do is we modify the earnings before interest and tax, because this is an accounting measure, earnings before interest and tax. What we do here is we add depreciation to earnings before interest and tax, because this earnings has deducted depreciation, but depreciation is not a cash expense, so the company would have more cash, and not this amount of cash. It will have the total of these two, as cash flow income. Therefore, we take that and divide by the interest rate. So we get this answer, 179.14. Note that this must always be higher than this, because your cash income will be greater than your accounting income. Alright, therefore this would be greater than this. So here is also multiple. So what does this reflect? Roughly about 180 times, or we can say 179 times. It means that the company's operating cash flow is 179 times the interest expense of the company in 2018. So that is what is meant by this ratio. Alright, with that we finish the second category of financial ratios. Now we move on to the third category, which is asset management or asset efficiency ratio. Now here we have many more ratios. This category has the largest number of ratios. We have 1, 2, 3, 4, 5, 6, and 7 ratios. 7 ratios altogether. But it contains, some of the ratios reflect the same information, the same information, but it is presented differently. Therefore, there are only actually 5 types of ratios, or 5 ratios. And here in the asset management category of ratios, it measures the efficiency in using the assets to generate sales. So it measures the efficiency of the company in using its assets to generate sales. So note the keywords here. So the keyword here is efficiency. Efficiency in doing what? In using the assets. Using the assets to do what? To generate sales. So there are 3 keywords here. Right. So in each ratio, we will look at which asset. So the keyword is asset. How efficient is the asset being used? How efficient the asset is being used, or how efficiently the asset is being used to generate sales. That's the basic idea of efficiency ratios or asset management ratios, or sometimes called turnover ratios. These are called asset turnover ratios. Okay, so we look at the first asset. Yeah, each one. Okay, the first two is about inventory. Yeah, the second two is about receivables. Okay, so these are the various types of assets, yeah, used to generate sales. Yeah, then you have net working capital, which is another type of asset. And then we have fixed asset, and then finally total assets. Okay, so these are the major ratios. Yeah, now let's look at the first one, inventory. Yeah, inventory. One moment. All right. Yeah, we'll come back. So we look at the first category of ratios, which is inventory. Yeah, turnover. Right. So inventory turnover here, okay, measures the cost of goods sold as a multiple of inventory. Yeah, it reflects the cost of goods sold generated from using $1 of inventory. So the formula for this is all these asset management or efficiency ratios will use one number from the balance sheet and one number from the income statement. Yeah, so from the balance sheet it takes the numbers for the asset, okay, but from the income statement it takes the number or the figure for sales, yeah, or cost of goods sold. In this case, okay, we take inventory. Okay, inventory turnover is always sales, or in this case cost of goods sold. Yeah, we take cost of goods sold divided by inventory. Yeah, so inventory is taken from the assets portion here, 501. Yeah, so it's actually 2006 divided by 501. Yeah, this number here. So we get this value. Yeah, this is 4 times, roughly 4 times. Yeah, now what does that reflect? Okay, what is the interpretation of this number? Yeah, so this number indicates that, yeah, this 4, yeah, indicates that the inventory, yeah, is turned over 4 times to attain the cost of goods sold. Yeah, because note this, yeah, the cost of goods sold, okay, is 2006. Okay, so the inventory that the company has, okay, at the end of the year is 501. Yeah, means this inventory must be sold and then restocked and sold again, yeah, 4 times. Okay, roughly 4 times. This is rounded to 2 decimal points, therefore 4 times, in order to achieve this cost of goods sold. Okay, so higher this number is 4 here, that means greater the efficiency of the company in using its inventory to generate sales. Yeah, that means it holds less inventory to generate more sales. Yeah, but higher, yeah, this number means higher efficiency, but lower, on the other hand, means lower efficiency. Is that okay? Alright, yeah, so that's the meaning of inventory turnover. Yeah, now we come to the second measure, which is day sales in inventory. Yeah, now this day sales in inventory is similar, yeah, to this ratio, or it is actually the same ratio but presented differently. Yeah, so actually this ratio, day sales inventory, is a reciprocal of this ratio. Right, reciprocal here means 1 divided by this ratio. Yeah, so this answer here, the formula here in basic terms, is 1 divided by 4, or 1 divided by the inventory turnover, multiplied by, okay, when it's 1 divided, then you call this reciprocal. But when you multiply this, then the second step is you multiply this, or you express this in number of days. Yeah, note that, yeah? It says days sales in inventory. So this unit is actually days. Yeah, 91.16 days. Yeah, so you multiply with 365 days a year. Therefore, it is 1 over 4 multiplied by 365 days. Yeah, therefore you get 91.16 days. So what does this reflect? Yeah? It reflects on average the time taken by the company from the time it purchases the inventory to sell the inventory. inventory. Yeah? Roughly you can say in very simple terms, the company takes about 91 days, yeah, to sell its inventory on average. Is that okay? Right, yeah, so that is the meaning, yeah, of this ratio. So both these ratios reflect the efficiency of using inventory to generate sales. Yeah, note that if this value is higher, let's say it's 5, then the day sales in inventory will be lower. Yeah, it will be less than 90, right? But if this is lower, right, let's say this is 3, then this will be higher. Right? So higher this number 4, let's say it's higher than 4, then the company is more efficient in using its inventory to generate sales. Yeah, but if this number is higher, it means day sales in inventory is higher, it means the opposite. Yeah? It means that the company is less efficient in using its inventory to generate sales. You know why? Because it takes longer to sell the inventory. Is that okay? Now, if this is lower, okay, 91.16, let's say it's lower, let's say 80 days, yeah? That means the company is more efficient in using its inventory to generate sales, yeah? Because it keeps the inventory for a shorter time period. Okay, it sells the inventory sooner, yeah? So that's the idea behind these two ratios, yeah? Alright, yeah, now let's move on to the next ratio, okay, or in this case the next asset value. Yeah, so this is receivables. Yeah, receivables. We have finished inventory, so the second asset is receivables. We look at the receivable turnover. Yeah, now the receivable turnover here, the formula is similar to inventory, but this time, yeah, in inventory we take cost of goods sold divided by inventory. Why is that? Yeah, in some cases, inventory turnover can also be computed using sales divided by inventory. Yeah? But the proper formula for inventory turnover should be cost of goods sold divided by inventory. Why? Because inventory is normally stated at the cost. It's not given at price. Yeah? The price of the inventory when you sell the inventory. Yeah? The inventory is stated at cost. The cost of you buying the inventory, raw material, and also the cost of processing the inventory into finished goods. Yeah? Because the inventory is stated at cost, okay, you need to take the sale value at cost, not at the price. Yeah? So you don't take sales here, you take the cost of sales, yeah, which is 2006. Alright, yeah, so we take sales for inventory, we take cost of goods sold because the inventory is stated at cost, but receivables, yeah, turnover, we take sales because receivables are stated at the price at which you sell the inventory, yeah, or at the price at which the customer needs to pay the company. Yeah, therefore it is sales divided by receivables. Yeah, okay, so we take revenue here, 5,000, divided by receivables. Yeah, we go up to the assets portion, 1156. Yeah, so 5,000 divided by 1156 would be your receivable turnover. Yeah, so it is 4.33. Yeah, it is 4.33. So how do you interpret this? Okay, the interpretation is, okay, the receivables, okay, the receivables, the denominator is turned over. Yeah? Turnover here means the receivables are collected, recreated, and collected again, yeah, 4 times, okay, in order to attain or achieve the sales of that year, right? So that is the meaning. Yeah, so greater this number means greater the turnover, means the company is more efficient in using its receivables to generate sales. Yeah, if this is lower, then lower the efficiency, yeah, in using receivables to generate sales. Now, day sales and receivables is similar to day sales and inventory. Okay, it's just a reciprocal of this. multiplied by 365. Yeah? So in order to get the